Hi everyone, it's time for our third video of our A Speaker series brought to you by Allianz Life. This video will share information on 3 key major tax issues that are emerging, examples of the impact, as well as drivers behind these issues. Now, let's welcome Waldine Wall, the VP of Advanced Markets at Allianz Life. Thank you.
Hello, my name is Waldine Wall, Vice President of Advanced Markets and Solutions at Allianz Life Insurance Company of North America. Today, we're going to talk about 3 emerging tax issues in retirement. 2 big drivers of these tax issues are, first, the amount of tax deferral in all the retirement plan money that's being accumulated, and second, a few recent federal tax law changes that could end up raising the tax bill on those who have done a good job in accumulating money for their retirement. In the end, it can be important to have a good retirement income strategy to help you keep as much of your money after tax as possible. Now, before we get started, please remember everyone's financial and tax situation is different, and this information is not meant to be taken as specific advice for your situation. You need to talk to your own legal, tax, and financial professional before you take any action. So let's look at tax issue number 1. I'm calling it Maximum Retirement Plan Tax Deferral. If you have a good size individual retirement arrangement, or IRA, and if you're planning to defer income taxes as long as you can, you might want to think carefully about that. As you might know, the Setting Every Community Up for Retirement Enhancements Act, or SECURE Act of 2019, changed the required minimum distributions, or RMD, age to 72 instead of 70 and a half. Now that sounds good, but for those who can afford to let their retirement plans grow tax deferred until they need to take required minimum distributions, they need to understand the tax impact that might be coming. Here's a chart that might help you understand just how big these required minimum distributions can be. So let's look at a hypothetical example. Here I'm illustrating the RMDs at various ages for a potential $1 million IRA, a $1.5 million IRA, and a $2 million IRA. If you go into retirement at age 65 with a $2 million IRA and you earn 5% a year on the IRA, your first required withdrawal or distribution at age 72 would be just over $104,000. At age 82, it's over $245,000, and by age 92, it's almost $670,000. Now, please don't misunderstand me here. There can be real value in tax deferral. But at this point, at least for some of you, the cost of all this deferral can be big, and the required income tax at withdrawal can also be big. So you should examine ways to help manage your tax responsibility with your tax advisor. Now, let's look at emerging issue number 2, income taxes for a surviving spouse. I've found that this can easily take people by surprise. Many don't see it coming and they don't plan for it. In this hypothetical situation where mom and dad going into retirement have a healthy retirement plan and they're hoping to defer the income taxes as long as possible, the surviving spouse might be in for a tax surprise. The issue is that the survivor usually keeps most of the income and the retirement plan with the required minimum distributions. But now he or she has a single income tax filing status. And as you might know, the single income tax filing status demands more tax when compared to the marrying filing joint status with the same amount of taxable income. This chart is designed to show you the difference between filing as a single taxpayer and filing as a married filing joint taxpayer. Here, at the bottom, we have different amounts of ordinary income for filers over age 65 and the amount of tax they would pay using the standard deduction. So in this hypothetical example, let's say a married couple has $100,000 of income. With a married filing joint income tax status, they would pay $8,317 in federal income tax, while a single filer with that same income would pay $14,707. The married filing joint filers are in a 12% marginal tax bracket, while a single filer is in a 24% bracket. So if the surviving spouse is in this situation for 10 years, he or she will pay almost $64,000 more in income taxes. When we move up to a $150,000 income, there's a 10-year difference of over $81,000. This can have a real effect on how long the income lasts, and this can affect the ability to pay for long-term care expenses or leaving money to the children or charities. It's also important to know that there can be additional costs tied to a change in tax status. For example, Medicare premiums are based on income, and when an individual moves from married filing joint to a single filing status, the premiums generally escalate at lower levels. Now, emerging tax issue number 3 can arrive when individuals leave a retirement plan to their children. Due to a tax change that was made by the SECURE Act of 2019, most children can no longer stretch out their income taxes over their remaining life expectancy. They must now empty the inherited IRA or the inherited retirement plan by the end of the 10th year following the year of death. A stretched distribution strategy is most effective when individuals can afford to minimize IRA distributions during their lifetime and are able to pass remaining assets on to future generations. Changes in tax law, the impact of inflation, costs, and risk of underlying fund vehicles may have a significant impact on the long-term value of your IRA. So here's a hypothetical example of how the old rule might compare with these new 10-year requirements. In this example, Karen inherits a $1 million IRA from her mother. Under the old rule, before the SECURE Act, Karen's first required minimum withdrawal would be under $26,000. And as you can see, it would increase each year until the inherited IRA is empty. So under the old rule, Karen had about 30 years to pay the income tax. Under the new rule, if Karen was to take the money out in equal amounts over the required 10 years, she would be paying tax on an extra $123,000 of income every year. And the tax bill on an extra $123,000 of income could really change things for her, right? So if we were to put this together and illustrate the issues in a hypothetical case, it might look like this. Let's assume this is mom and dad and they've done well. They're going into retirement with Social Security, a small pension, $1 million of cash, and $1 million in their IRA. And they want $120,000 a year after taxes. And we're going to assume that dad will die at 80 and mom will die at 95. If they're determined to defer tax on their IRA as long as possible, it might look like this. Initially, their tax rate is really low because Social Security is not fully taxable and they're using their cash first. But you can see when RMD age hits, their taxes would jump. And when dad dies and mom now files as a single taxpayer, the taxes will jump again. And then mom dies, and most of what moves to the next generation would be taxable income. In this alternative hypothetical option, you can see that we've leveled out the income tax losses by doing Roth IRA conversions when the income tax rates are relatively low, instead of withdrawing later on when the income tax rates may be higher after leaving the pre-tax money to defer for several years. One of the benefits is that the taxable RMDs will be reduced when mom is filing as a single taxpayer, as highlighted in the yellow area, and would have access to income tax-free money from the Roth IRA when a qualified distribution occurs. This also means that much of the money that moves to the next generation would also be income tax-free. For anyone considering this strategy, you should consult with your tax advisor to determine if a Roth IRA conversion could be effective for you. It's generally preferable that you have funds to pay the taxes due upon conversion from funds outside of your IRA. If you do elect to take a distribution from your IRA to pay the conversion taxes, please keep in mind the potential consequences, such as assessment of product surrender charges or additional IRS penalties for premature distributions. And please remember that converting an IRA or retirement plan to a Roth is a taxable event. Increased income taxes from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, higher Medicare premiums, and higher taxes on Social Security benefits. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA or retirement plan. If a traditional IRA annuity is converted to a Roth IRA, the taxable amount of the conversion may be more than the annuity contract value. So how does this all work out in the end? These are projections of available money after mom dies. We've estimated this at ages 85, 90, and 95. Not only would mom have more money in the alternative scenario, but she would have more income tax-free money. In fact, at mom's age 95, it's estimated that only 27% of the money that goes to the children would be taxable as income. Now, as we close here, you need to know that designing an effective retirement income strategy is not a one-size-fits-all effort. Your situation is unique, and there are many possible tools and strategies that might help. So please talk to your tax advisor. You should also know that annuities can help meet your long-term retirement goals by offering tax-deferred growth potential, a death benefit for beneficiaries during the accumulation phase, and a guaranteed stream of income during retirement. So talk to your financial professional to see if an annuity is appropriate for you. Thank you.